analysts are still betting that the Fed is going to cut rates in September. This after the weaker than expected jobs report that we got last Friday. Fed Speak on Deck this week may give a little bit more insight or more clarity on the exact timing and possibility here of a rate cut. To break it all down, we want to bring in Sam Stovall, CFRA Research Chief Investment Strategist. And Sam, it's good to see you. So let's talk about the moves that we saw at the end of last week. We saw gains. Here we are again, opening the trading day here on a new week. We're pushing even further here to the upside. Lots of optimism that we're going to get a Fed rate cut. Do you think that's the right read?
Hey, Shauna. Yeah, yes, I do think we're going to get a rate cut. Actually, I think we might end up with two, possibly first in September and then the second in December. And no, September is not too close to the election. Interesting, but if you go back to 1992, when the Fed really started telegraphing Fed funds rate changes, every presidential election since 92 except 2012 saw a rate hike or cut take place in an election year, and many of those took place in that third quarter. So there is still the possibility that the Fed will try to let us know that they are apolitical and do what they think is right for the economy.
I mean, there's two meetings that are prior to September as well here that are still on the docket, Sam. So what can take place in terms of the trend that the Fed is looking for, perhaps being thrown off course to the point where they would need to recalibrate their own assessment?
Morning, Brad. Well, I think certainly looking at the employment data this week, we're pretty ho-hum in terms of economic reports. But next week, when we're looking at CPI and PPI, the encouraging bit right now is that the street is anticipating that the April data will end up being softer than the March data, and that could further encourage investors that maybe the Fed is closer to their first rate cut of this period. So I would tend to say, obviously, that the Fed reminded us that they are data dependent, and they will continue to monitor everything and make the decisions based upon that.
Sam, what do you expect to see just in terms of the improvement on inflation? We've kind of been trending sideways now for just a bit. Why is the market so confident that we are going to see that further improvement then to the downside?
Well, I guess you could say that investors are a little bit like hyperactive first graders playing musical chairs, always trying to out-anticipate the other as to when the music will start or stop. And then knowing that we're not going to be seeing a rate hike, chances are. So therefore, a cut is the next step. And investors are anticipators. Traditionally, there has been an 11-month separation between the last rate hike and the first rate cut. We've had six of those, 5 of the 6 times going back to 1990, in which the market rose. The average increase was about 14%. So essentially, investors are saying, we know that a rate cut is coming. We just don't know exactly when, but we are going to play into this optimism by buying whatever dips there happen to be. And that's why, as Jared just mentioned, there's a good likelihood that because we're closing above the 50-day moving average, could be encouraging that this pullback of only 5.5% has concluded.
Yeah, Sam, you triggered my own memories of making a bunch of jab steps towards the chairs during musical chairs, trying to time the music here. So thank you for that. You know, ultimately, investors trying to figure out if they need to be doing any repositioning going into and amid an environment where we're hearing for less rate cuts than anticipated to start this year, especially off of Friday's employment situation data. And, you know, God forbid an investor took the day off or started the summer Fridays early after we got that weaker than expected print.
Well, I think what's interesting is we're starting to see more attention be paid to some of the defensive areas of the market, in particular utilities. I think investors are saying, you know what, this group is trading at a more than 20% discount to its long-term relative PE. It's been under pressure because of the uncertainty surrounding the rate cycle. But I think that because valuations look relatively attractive, and we are in the traditional sell in May period, which is sort of challenging for investors. In election years since 1990, the S&P has gained only 0.5% from May through October, whereas the more defensive sectors, consumer staples, healthcare, utilities, have posted increases in excess of 3%. So I think investors are sort of playing it safe by adding to their positions with utilities.
Sam Stovall, CFRA Research Investment Chief Investment Strategist. Sam, great to speak with you as always. Thanks so much for kicking off today's trading activity with us.
My pleasure. Thanks.